Welcome to The Explainer. Today, we're diving into an absolutely wild truth that is hiding right in plain sight within today's luxury truck market. Look, we all see them every single day, right? These massive, gleaming pickup trucks absolutely dominating our roads. But you have to ask yourself, what is actually financing this massive fleet? Well, as we dig into the data, the dealership tactics, and the behind-the-scenes Wall Street maneuvers, we're going to uncover exactly what's happening beneath the hood of the American auto industry. So, let's just jump right in.
Remember the 2008 housing crisis? We all kind of thought that was a one-and-done, catastrophic event. But the data is telling a very different story today. It turns out that exact same financial toxic waste has just been repackaged. Right now, a phantom debt bubble in auto loans is ballooning up, and it is ready to burst. By the end of 2024, more Americans were underwater on their truck loans than at any point in history. And when this bubble pops, it literally threatens to lock an entire generation out of the housing market.
Section 1. The Pavement Princess Phenomenon. To really understand the sheer scale of the financial stakes here, just take a look at your local suburban office parking lot. There has been this highly visible cultural shift of vehicles, often costing well over $100,000, just flooding these lots. And the monthly payments attached to them are staggering. In fact, there was a viral example recently featuring a driver who mentioned her husband's GMC Sierra 1500 AT4 came with a monthly payment of $1,600. I mean, just let that number sink in for a second. That is a car payment that is just $500 short of the median monthly mortgage payment in the whole country.
But that begs the question, what are these massive trucks actually doing to justify that cost? Well, despite the hefty price tag and all that rugged off-road marketing, 75% of Ford F-150 owners tow something with their truck once a year or less, and only 30% will go off-road more than once a year. It's basically the equivalent of buying a $1,200 deep-sea diving suit and wearing it for your daily morning shower. Most of these luxury truck owners simply do not need a truck, and the refusal to get these vehicles dirty, that is exactly what earned them the nickname Pavement Princesses.
Section 2. The monthly payment trap. So how on earth do buyers end up with these massive, suffocating liabilities? Well, we have to look at the massive shift from the low-interest era of the 2010s to the staggering rates we're seeing in late 2025. Take consumer Melissa Dickerson, for example. After her son got into an accident, she had to replace a car that she had been paying just $400 a month for. She walked out of the dealership with an $1,100 monthly payment at a roughly 15% interest rate. What's happening is that buyers have completely stopped looking at the total sticker price. Instead, they're getting trapped by focusing solely on what they have to pay month to month. And dealerships absolutely weaponize this focus. They use a classic industry tactic called the four-square worksheet. Now, it seems informative at first glance, but former car dealers will tell you straight up that it is literally designed to steer customers toward the one number that will close the sale, the monthly payment. If a customer hesitates, the dealership negotiates that monthly number down by secretly extending the loan term. This means the customer ends up paying significantly more overall, all while the dealer gets to hide much higher interest rates.
Let's break down how this builds into an even more dangerous practice, rolling negative equity. Here is exactly how dealers push buyers further and further into debt. Step 1. A customer trades in a car they already owe way too much on. Step 2. The dealer generously offers to just pay it off for them. Sounds great, right? But step 3 is the trick. That old debt is secretly folded right into the new loan's principal, or shaved off the down payment, without making it obvious in the contract. So by step 4, the customer is paying a sky-high interest rate on a massively inflated total balance, usually without even fully realizing what just happened.
Section 3. The death of affordable trucks.
Of course, this shift didn't just happen in a vacuum. Once the big three automakers realized they could sell increasingly expensive vehicles through this monthly payment financing scheme, affordable cars practically vanished overnight. I mean, the simple $38,800 Ford F-150 XL-based work truck is being aggressively slashed from production right now. And in its place, automakers are prioritizing models like the F-150 Platinum trim, which is essentially an $87,000 rolling luxury suite. When you have supply shortages, a truck that generates an extra $35,000 in revenue is a pretty easy choice for automakers to prioritize.
Section 4. The silent wealth killer. To make these $87,000 trucks seem even remotely affordable on a monthly basis, banks and dealerships had to normalize the 84-month loan. Let's just walk through this agonizing 7-year timeline. Back in the mid-2010s, these ultra-long loans were heavily criticized. As recently as 2015, Honda's U.S. sales chief called 84-month loans stupid, not just for us, but for the industry.
Yet, fast forward to the second quarter of 2025, and over 22% of all new vehicle financing was made up of 84-month loans. Think about that. You are spending 7 long years paying off an asset that is aggressively losing its value the entire time.
Because look, we all hear the myth that trucks hold their value, right? Well, the reality is rapid negative equity. A Ford F-150 Platinum experiences a shocking 25 to 30% year-over-year depreciation. Look at year 3 of this loan. A customer who puts money down and gets a pretty good 7% interest rate will find their truck is now worth only $43,500. But if they've made every single payment right on time, they still owe $50,400 on the loan. They are immediately $7,000 underwater. They are completely trapped.
So what is the actual opportunity cost of all this? Prepare yourself for this one. $2.97 million. That is exactly what a $1,300 monthly truck payment would yield if it were just invested into the S&P 500 for 30 years instead. That is not just a cushy retirement fund, guys. That's 3 luxury homes or a private island. These excessive, long-term, high-interest auto loans are literally eroding our buying power and destroying household wealth.
Section 5. Wall Street's Subprime Casino.
Okay, so here is the massive plot twist of the whole explainer. If so many people are defaulting and underwater on these cars, aren't the banks losing money? Actually, no. They aren't losing a dime. They've shifted the risk using something called securitization. This is the exact same financial mechanism that caused the Great Recession with mortgages. They take these risky, subprime auto loans, bundle them all together, and sell them as bonds to investors on Wall Street. And because car dealerships fought incredibly hard and won an exemption from supervision by the Consumer Financial Protection Bureau, this market operates with an insane amount of leeway. They spread the risk out so the consumer loses everything, but the bank still wins.
Just look at how lucrative this subprime casino actually is for them. In one major example, the Santander Drive 2019-3 Trust bundled $1.21 billion in subprime auto loans. They charge these risky consumers an average of 19% interest, sometimes jacking it up to 29.99%. But they only had to pay their bondholders about 3% interest. This structure was quite literally described as a bomb shelter against a nuclear blast. Santander designed it so that even if a staggering 42% of their customers defaulted, the bank would still come out ahead. Ultimately, Santander collected $121 million in fees, plus a $155 million bonus, all while over a quarter of its customers had their vehicles repossessed.
Section 6. The Looming Credit Collapse.
So, what happens when this entire house of cards finally hits a wall? Honestly, this $100,000 truck is truly the canary in the coal mine for a much larger economic disaster. Just look at the late 2025 reality. There were 2.87 million unused vehicles just sitting on dealer lots. That is more than all the registered cars in New York City combined. The days supply for Chrysler and Ford is sitting at well over 110 days. But most worryingly, 6.65% of subprime borrowers are past due right now. That means 2025 delinquency rates have officially beaten the peak rates we saw back in 2009. The corporate fallout is already happening too. Texas subprime lender Tricolor Holdings suddenly collapsed, which triggered a massive federal fraud probe and sent shockwaves through huge financial giants like JP Morgan and BlackRock.
Which leaves us with one incredibly vital question to think about. Are we simply buying the appearance of success while permanently sacrificing our own financial freedom? Dealerships and banks found a brilliant way to make incredibly expensive, often completely unnecessary vehicles feel affordable on paper. What was once a reliable, affordable work vehicle for the middle class has been completely transformed from a tool of labor into an instrument of financial extraction. In the end, it really wasn't the trucks that changed who we are. It was the massive, crushing debt we were willing to take on just to own them. Thanks so much for joining me on this explainer, and remember, always keep questioning the numbers behind the sticker price.